Today, traders, I've got Paul Nolte. He's the Senior VP and Portfolio Manager at Kingsview Asset Management. He's joining us here to help us break down some of the recent price activity we've been seeing in the currencies. Paul, it's great to have you back. I think it'd be a mistake to start with anything other than getting your thoughts on how big of a deal is the 730 number for the dollar today and the foreign currency traders, and what should they be dialed in on here most?
You know, what's going to be interesting is August is notorious for big misses in the employment report. We're expecting 190, 187, but over the last 10 years or so, August has generally seen some big misses. Would not be surprised to see something below 125.
Wow.
Yeah, it's going to be, it has that potential. So whether it comes through or not, ADP was a little soft yesterday, but certainly not enough to warrant a big concern. But again, that's the history lesson for August. What we're probably going to see out of the dollar is still some strengthening in the dollar. What's keeping the dollar where it's at right now is still a very strong Fed, and a Fed that's very willing to raise rates. It's 100% sure that they're going to go at the end of this month, and that's keeping a bit under the dollar. It's come down from its peak at 97 down to the 95 range. And as we've talked about before, we're still stuck in that range between 94 and 95. We thought we had a nice break going higher, going up to 100. That reversed, false breakout. We're back in that range of 94, 95 on the dollar. We're going to be there, I think, through the Fed meeting. Once the Fed meets and we start to see what they come through with in their comments after the rate hike, I think that will be the catalyst for the next move in the dollar, probably higher.
Yeah, certainly a lot of focus on the Fed coming up in a few weeks, but even sooner than that, we have the ECB and we have the Bank of England next week. But, you know, I want to get back to that potential call for a lower level in terms of this jobs data. If we get something as low as around the 125 level, Paul, does this encourage or influence, I should say, the Fed's decision for that DECE rate hike any one way or the other, or is that just pretty much a done deal as well?
Well, right now it's running at about a 75% chance that they go. And I think it does. I think it does have an impact on it. If you listen to the comments from the Fed governors, they're talking that it's going to go in December as well. So a 75% chance is pretty much a layup in the futures markets. So I think they're going to go anyway. The risks are, and we've talked about this for a long time when we come to the economic data, the Fed never stops raising rates until something breaks. And what we're starting to see is breaking, and it's all in the currency markets, and it's all around emerging markets. And that's maybe where we're starting to see some of the stresses right now.
Yeah, you know, I'm glad you brought that up, because that's what I'm wondering is what is going to break next. Paul, we've been in a bit of a sweet spot between really strong economic growth and moderate or manageable inflation, but at some point, something's got to give. Question is when and what. Do you see inflation becoming unmanageable before the slow and steady rate hikes start to weigh on the indices?
You know, that's the interesting part about it. We've been looking around for inflation in all kinds of places and not really finding it. We look at the CRB index. It bottomed out January of 16, but it's gone through long periods of generally sideways moves. So you look at the metals, the softs, and a lot of other things outside of crude, really not a lot of move in the commodity market, which leads me to believe that if commodities are not flying, is the economy truly as strong as we think it is? Because you would expect with an economy growing at 3 to 4%, we would see much higher rates of inflation. You'd see some tightness. Where we're seeing tightness is in the labor market. We have huge overhang in debt, and I think that's one of the reasons why we're not seeing inflation take off right here. The consumer can't afford it. So we're not getting cost of living increases anymore. Wage growth is stuck at 2.5%, and I think you're going to find inflation kind of tagged to wage growth. Until we see wage growth significantly above 3.5%, you're not going to see inflation much above where we're at today.
Well, that certainly gives us something to watch for here today in terms of the number as well. But Paul, let's talk a little bit about the Canadian dollar. Let's talk about the peso, because they've been coming under pressure here over the last few days after, for the most part, a nice run-up into and throughout the month of August. I'm wondering if trade tariff concerns and just the prolonged or the drawn-out impact is starting to weigh on them.
I think that's exactly what you're seeing, and that's really where we're seeing the impacts of trade tariffs, whether it's with Canada or Mexico, or it's China or Europe. It's coming out in the Forex markets. So we anticipate that we're going to still see, in general, our call is for a higher dollar, which means weaker currencies around the globe relative to the dollar. That should generally be true with Mexico, even though we've inked that deal. Canada is still trying to work on it. In Canada, too, is going to be impacted with energy prices. Energy prices have come down just a little bit, not significantly yet, but I think that's where we're seeing the impacts of tariffs is truly in all the Forex markets.
Yeah, it's also been kind of interesting to watch the disconnect between crude oil and the Canadian dollar with all of these outside influences playing on them. But let's talk about another currency that's been under pressure, Paul. Let's talk Aussie dollar. Recently into new 2018 lows. What's got them under pressure here?
They have some problems with their central bank. They've had a lot of turnover. They're not quite sure what their monetary policy is going to be. So there's a lot of moving parts with their central bank and what they're trying to do. So that one's a tougher call at this point. It's one that we've generally shied away from. It's a tough and smaller market for us to call. So we've generally stayed away from the Aussie dollar here.
All right, so let's talk a little bit about central bank, and then we're going to go into break. We'll get that number and get your thoughts as we come out of the break. But, Paul, ECB next week, Bank of England, any indication that we're anywhere near some more hawkish tone from them or any changes in terms of tightening monetary policy?
We're almost getting close to kind of sort of thinking about maybe being a little tighter. And that's really the comments that we're getting from Draghi. Is it's still somewhere out there in the future. Yeah. We're still thinking about it and keeping an eye on it. Actually, the more bullish, if you will, central bank is England. They're really dancing a fine line with Brexit and some of the issues that they have there. But they have talked a much tougher tone on interest rates and seem to be a lot closer to raising rates than certainly the ECB is at this point.
Let's talk about the jobs data here. Let's talk about market reaction too. First here, traders, let's take a look at the numbers here, which just came in this morning. Again, they just got released here today at 7:30 a.m. Central Time. If you take a look here, you're going to see non-farm payrolls coming in 201,000. They beat the estimates of 195. We got the unemployment rate, which came in here at 3.9. They were looking for 3.8. Private payrolls above expectations as well here, up at 204,000. They were looking for 190. If you take a look at manufacturing payrolls, down 3,000. They were looking for a small build there. But, Paul, so far it looks like the numbers were a bit of a miss, but to the upside.
They were a little bit to the upside, but of course we always got to take a look at those revisions, and they revised down the prior 2 months by a total of 50,000.
Okay.
So backing that out, you're down to about 150, 155,000 for this month's jobs report. So a slight miss. Again, these numbers on a month-to-month basis are incredibly noisy.
Yeah.
So it's better to take a look at a 3 to 6 month average. We're still running at 175 to 180,000 month over month over the last 3 to 6 months. A very good rate. We saw wages tick up a little bit more than expected, and I think that's got the equity futures at least a little bit on their heels. You get that normal knee-jerk reaction. We expect it to even out a little bit over the course of the trading day, but at least the initial reaction was a little bit negative in the equity market as well as the bond market.
Yeah, Paul, I want to pull those wages numbers back up again because I think that's what the market's reacting to right now, it seems like. Let's take a quick look here again. Not only wages here, but let's take a look at the wages and the participation rate screen there. That's the non-farm payrolls here. If you take a look here again, you're going to notice wages on the average hourly earnings up 0.4%. That's a nice move there on the year-to-year, Paul. Check it out, 2.9%. Notice here that participation rate ticked down a little bit as well. This is probably why we've got Treasuries selling off a bit here, correct?
I think so. And really, I think the number that everybody's looking at is more the wage number. Instead of the unemployment report, we should be calling this the wage report because it's really what we're focused on. Again, we're getting close to that 3% level. Historically, it's between 2 and 4. We're going to start to see some serious commodity pressure, I think, and inflation pressure we get above 3.5. So we still got a ways to go. It's been a slow grind higher, but this is maybe one of the first things that we're starting to see. We've all been asking, when are we going to see the wage growth? We may be starting to see some of those early signs here.
Yeah, Paul, I want to talk a little bit about the Treasuries and the markets. Basically, at least in the 2-year, the continued weakness that we've seen there. We know that, again, the Treasury markets and that shorter end of the curve there, or of the futures markets, definitely more dialed in and susceptible to some of the comments from Fed chair and some of these comments that we have from Fed speakers. But talk to us about the fact that we've been watching this shorter end leading the longer end lower. I'm wondering, is the 2-year telling us that more to come as it continues to push into new 2018 lows here?
I think so. You know, when you take a look at the overall yield curve, we're seeing it flatten. It's kind of taking a rest here at about 20-25 basis points. We're going to see continued pressure on the short end of the yield curve. The long end is waiting for inflation to show up. So again, you're going to want to keep an eye on the 10 to 30-year bonds. They've generally been pretty flat here over the last 2-3 months. We've seen them, interest rates go up pretty significantly over the last 2 years, but over the last 3-4 months kind of flattened out. Meanwhile, the short end of the yield curve has certainly continued to trek higher. 1 month, 3 month T-bills all moving higher. So we're going to see a flatter yield curve. If the Fed decides to go in December, we are running in the coming into the new year at least with a flat to maybe inverted yield curve, unless we see the 10-year bond pick up in yield, decline a little bit more in price.
Paul, remind me, I think we've talked about this before, but does the inverted or potential for inversion, as you mentioned, maybe as soon as December, does that concern you at all?
It does. It does concern us. I mean, we're starting to see some of the weakness in some of the other parts of the economy. Weakness relative to the recent strength. So it's not certainly recessionary, but it is one of those flags that starts to fly, gives us a little bit of reason to pause, maybe take our foot off the gas when it looks at the equity markets and be a little bit more cautious. That only starts the clock ticking for recession. Doesn't mean the recession is here, but it starts the clock to tick. And we could see it as early as mid to late 2019.
You know, Paul, when we take a look at the bigger picture, the daily charts for the Treasury markets, well, at least the 5, 10, and the bonds, they've been very much range-bound. For many traders who like the volatility and the major swings, the range-bound price activity can be a little bit frustrating, but it can provide some nice opportunities for option strategies that benefit from some consolidation and, well, breakouts, which we haven't seen yet, but at some point one will come. How much do you use options to benefit from situations where futures might not necessarily be the right tool for the right job?
You know, we do use a lot more in the option market than we do actually in the futures markets. We certainly, when we see that volatility come down, and you're right, on the Treasury side, it's the lowest volatility we've seen in 4 years. We've seen it on the equity side as well, where, you know, essentially we can buy those put options for free given the very low volatility. Same thing is true in the Treasury markets. So you're seeing those very low vols. It tends to be the best decision is to go against where that complacency is. And betting is right now more on the upside than on the downside. And that's where the protection comes in.
All right, well, definitely something to watch here. Paul, real quick, this week we saw the trade deficit gap to a 5-month high to over $50 billion. If this continues and it starts to weigh on economic growth, would you expect to see the bonds come under pressure and start to see some selling resume?
Maybe. You know, that's the interesting part of this. Is when you take a look at the trade figures, I mean, it's certainly going against everything the administration is trying to do, and maybe emboldens them to put on additional tariffs.
Good point.
And one of the things that we're concerned about is, you know, again, when you're looking at the inverted yield curve and some of these other things that are starting to come up, and the potential for a recession, when you start to see that curve invert, if you go back over history, the best thing to do in the football parlance, and since we're starting the new football season, it's go long. And that's really what you want to do, is start looking at the 10 to 30-year bonds. Interest rates on those generally will come down after the yield curve inverts. So take a look at that strategy. It's counterintuitive, but it may be something to look forward to in the first quarter of next year, to start looking at those 10 to 30-year bonds to go along those bonds.